Price, that's the number one technical indicator.
You do best by investing for the longer term.
If you can't explain what the business is doing, then that is a huge red flag.
Some technological change is going to put you out of business.
It really is a genuinely extraordinary situation.
Welcome back. I'm Hayden Brain, and you're listening to Opto Sessions, where we interview the top traders and investors from around the world, uncovering their secrets to success. Frédérique Carrier is Managing Director and Head of Investment Strategy at RBC Wealth Management. She heads up the firm's London equity desk and formulates equity strategy for the UK and Europe. Frédérique also co-chairs RBC Wealth Management's GPAC committee, which determines asset allocation for the firm's global client base. As of the end of last year, RBC had $843.6 billion Canadian dollars under administration, making it the fifth largest wealth manager in the world. Having spent 8 years at companies like Williams de Broë, managing several European equity mandates, Frédérique had previously taken him 5 years at BBVA Latinvest as a sell-side analyst covering Latin America. A subsequent stint with Invesco, covering emerging markets and global equities, preceded her current position. Frédérique and I discuss what leading a global asset manager is like before we embark on a whistle-stop world tour where Frédérique offers her investment outlook for the US, Europe and UK, and emerging markets too. Enjoy the interview.
Welcome to the podcast, Frédérique. It's great to have you on the show. How's your week been so far?
Thank you, Haf, for having me. The week has been good. It's been busy. Lots of queries about inflation. I think very much like clients really worried about COVID, and we talked about COVID for weeks and weeks and weeks and weeks in terms of the numbers, fatalities, vaccine rollout and the like. I think the new topic is inflation.
Yeah, no, absolutely. And hopefully we can touch on that today as well. And whereabouts are you based? Are you in the UK?
In central London, yes.
Yes, okay. Great, because I think RBC have actually got an office around the corner from CMC Markets office, so near Liverpool Street, is that right?
That's right. We recently moved to 100 Bishopsgate.
Yes, okay. Nice, all right. Well, good to know we're fairly close. So I'll kick off just by getting into a topic that I think we'll discuss in more detail later on. And then what we'll do is we'll circle back and cover your background and what you do on a day-to-day basis. But firstly, I think we spoke to you at the beginning of last year, or at least my team did, for the latest issue of our print magazine. And it was just before the coronavirus had properly took hold. And we asked you to identify the most influential event in your career. So you answered the 2008-9 financial crisis. I don't think anyone could really argue with that. And I don't necessarily expect that to have changed. But can you sum up the impact of this pandemic? You know, what impact it's had on your career and just your day-to-day role at RBC as well?
So the impact on the career is really the fact that many of us are now working from home. But having said that, so the hours are a lot longer. They sort of bleed into your private time more easily. But there's no impact per se on my career at this stage. There has been some changes, but not due to coronavirus. I think the one thing I've noticed is that, and we can get into that later, but I do quite a bit of broadcasting. And it's now a lot more competitive to get broadcasting time. That's because networks used to count on people to come over the studio. Now they have access to a much wider pool of talent. So it's become a lot more competitive.
Yeah, no, I completely see that. And that's exactly the sort of stuff I wanted to get into and just sort of make it less abstract for the listeners, I suppose, how a pandemic affects someone in your position. And that point about people having access to experts from across the globe now, because obviously people are working from home and have more time to work with broadcasters. It's a really valid one. And actually, that's something that's probably benefited the Opto Sessions podcast to a larger extent as well. One of the many reasons, I suppose, we've got time with yourself.
It's also benefited me in a way that I can have, now have access to networks on the other side of the world as well. So it goes both ways. And the impact on day to day, I've really noticed a change in attitude. There's certainly a lot more empathy around personnel, health, economic and social impact of COVID, both with your colleagues from around the world, but also with clients whose lives also have changed. And you see people in a new light, a new angle. There's been a feeling of togetherness, which really we didn't have that much before. And in a way, it's been slightly easier to stay close to clients in that respect amid the market volatility.
Yeah, that's interesting. I think you're spot on about sort of viewing your colleagues in a slightly different context, seeing them within their homes, and obviously seeing them balance their personal side of their life, their personal schedule versus their work one. I think it's been at least really encouraging in that sense. Obviously, there's plenty of negatives that go with it as well, some of which we'll discuss from an investment perspective later on. But let's circle back and cover your background now and just kind of get into detail on what you do on a day-to-day basis at RBC. And let's start by going through some of your more recent roles chronologically. So before you get to RBC, I think you were at Invesco for over 6 years, managing Latin American EM and global funds. And that Latin American focus preceded that role too, as you previously worked for BBVA Latinvest for 5 years in the 90s as well. So you've got a wide remit. You maintain that wide remit in your current role. You have to have a global focus, I suppose. But how important has it been for you to build intimate knowledge of different regional markets like Latin America?
It was a very good learning experience in terms of the specifics of Latin America. Latin America is now a much less important market than it was in the early 1990s. But in terms of financial analysis, in terms of interview skills, when you speak to management, all this were skills that I was able to apply to other markets, be they developing markets or even mature markets. And it's proven very useful. And so you deal with Latin America, you deal with the Mexican peso crisis in 1994, and then all of a sudden in 2018 you have a Turkish lira crisis, and a lot of the factors are the same. So it was the Latin American experience, perhaps not directly applicable, but some of the skills certainly very useful, and these are skills that I still use today.
Yeah, great. I think that's what it is, regardless of whether, I guess, Latin America, which you definitely rightly point out, has become less important perhaps as a market and less significant. I think it's just those skills that you build up over time by focusing on a specific market. And I want to get into that later on in your career as well. I think you worked as an investment director, again managing funds at a company called Williams de Broë, amongst others. And as part of those roles, it seems you focus your attention on European markets as well. So you transition to focus on European markets from perhaps a Latin American focus in previous roles. So firstly, from someone that doesn't work within the fund management space, how easy is it to transition from market to market? And secondly, do any market-specific idiosyncrasies stand out to you?
So look, at first I point out, it seems that I hopped around jobs around a lot, but all these changes were all as a result of takeovers. So yes, I didn't move my feet, we just kept on being taken over. As things evolved, I think I was active in taking in moving away from strictly Latin America. After 5 years, I became quite disillusioned about where the region, how it would grow in the long term, where it would, and I felt I needed to broaden my experience. So I made consciously within these companies the move to go from Latin America to emerging markets, and then there was an opportunity to move to Europe. And as you know, a lot of Southern European companies are involved, heavily invested in Latin America. So in a way, I could bring something to the European team there. Okay. Again, it's about using your experience and making it work elsewhere.
Yeah, absolutely. Yeah, that's interesting that you're able to transfer that knowledge across into the new role. And I'm not giving times on some of these roles, but you're in these roles for multiple years. I think the two investment directorships that I mentioned just a minute ago, that you're in those roles, for a combination of about 8 years, I think. So certainly not hopping around, but I get your point about the takeovers. So then since November 2011, you've been with RBC, taking the head of investment strategy role back in March 2017, I believe. So firstly, can you just sum up what your current role entails for us?
So look, my role is at the moment basically two things. One of collating our investment leaders' views on markets, and with some colleagues forming the house view with their help. So talking about these views, writing, publishing a lot of research reports. So I'm a spokesperson for wealth management for clients and for the outside world.
Yeah, okay, yeah. And you, as part of that, I suppose you co-chair RBC's Wealth Management Global Asset Allocation Committee. So, I mean, you've touched on it there, but can you get into detail on what the key responsibilities are as part of that side of your role?
Yes, so the Global Asset Allocation Committee meets on a weekly basis to discuss key economic and market events and other factors which might affect global financial markets. And those meetings are really the anchor of my week. They happen every week at the same time, and everything revolves around that. And the committee includes senior investment leaders from around the world, and it leverages all the resources and all the insights of RBC as a broader organization. So that includes capital markets, our institutional asset management arm, among other things. And again, the committee is responsible for producing frequent and regular thought leadership pieces, and responsible to provide objective guidance on a broad range of investments to our clients and to our investment advisors.
Yeah, great. I can imagine those are fascinating meetings to be part of. Okay, well, finally, before we move on to RBC's investment philosophy, RBC, at least I read yesterday, have 843.6 billion Canadian dollars under administration. So I think that figure was taken at the end of 2020. So it may have even grown since then. But I think that makes RBC the fifth largest wealth manager in the world. So whether that's right, it's safe to say it's a very large organization with a lot of assets under administration. So I'm interested in understanding what it's like to operate at such size and whether that presents any challenges from an investment perspective. You got any thoughts on that?
So people are often surprised when they hear how big RBC is, particularly in regions where we're less known in Europe and Asia. Certainly, we have a much higher profile in North America. But look, I'll say that being large, being global, it's really a strength and a stability that are particularly valued at the current time. And while we are very large, we are a global organization, as I mentioned, and that enables us to apply a very broad expertise and very deep knowledge to the financial needs of our clients, which can be quite sophisticated. So I would stress that more than for any companies that I've worked in before, we have a really highly personalized approach with our clients. We have an extremely collegiate culture of collaboration among teams worldwide. And to be honest, how well it works doesn't cease to amaze me. I see it in action at the Global Asset Allocation Committee every week with colleagues from Canada, the US, Asia, and of course here in the BI, and that's very, very special.
Yeah, it certainly seems it. I mean, I guess when I bring up sort of drawbacks in terms of operating at such a significant size, I'm thinking about agility. Smaller firms might be able to be more agile in their asset allocation. For example, I wonder whether you've got any thoughts on that, how RBC are able to remain agile in what are quite volatile markets, particularly at the moment.
So I think you mentioned we're over 80,000 employees. It doesn't mean that all these employees work on our clients' portfolios, right? We have smaller teams and wealth management in terms of organizing the house view. It is it's a very agile, quick-moving group where a lot of conversations take place at the usual scheduled time, but also ad hoc conversations. We all want, what's best for our clients, and therefore agility is very important. It's a market where timing is, or an industry where timing is very, very important, and that is certainly taken into consideration.
Yeah, okay, absolutely. All right, well, let's get into RBC's investment philosophy then. Just want to understand sort of any overarching principles that might govern RBC's thinking. And again, in that interview you gave us last year, you described the three key pillars of RBC's investment philosophy as fundamentals, valuation, and sentiment. Can you briefly explain why you focus on these three factors specifically?
So look, the world financial markets, that it's very complex, right? And there are so many factors to look at, so many variables, so many data points. And most of them are ever changing. Mm-hmm. And so it's important to have a framework on how to think about markets and investment decisions. And we found that, the variables that we look at, that all the specialists in their different asset classes, their different regions, all these variables that they look at really fall in these three buckets. And they really help us see more clearly what the situation is. And by using the framework, it's also helps us explain to clients how we invest and the rationale of our investment decisions.
Yeah, okay, that makes sense. I guess it means that you've always got a consistent sort of set of pillars or principles that you can fall back on to root all of your investment decisions in, which I can imagine is extremely useful. I guess then what I'm thinking when you tell me and explain those pillars is, how do they separate you from your peers?
So this is the key in terms of timing and asset allocation. In terms of what differentiates us from others, I would say ESG. So it's not a differentiating factor now, but RBC has been doing this for many, many, many years, long before it was fashionable. And we're now going one step further with impact investing. So measuring the impact, the benefit that investments, client portfolios can have, for instance, on the environment. And so this culture that leads us to look very seriously at themes such as sustainability. So sustainability through technology is a very important theme for us. We are biased towards companies which provide technological solutions to the sustainability challenges that we have today. For instance, climate change, difficult access to fresh water, growing healthcare costs, and the like. And it also leads us to think outside the box. So, for example, for some portfolios where it's appropriate for risk tolerance, we have purchased an EU emission allowance note to capitalize on what we expect will be an increase in carbon allowances prices. So we believe that as the world strives to reduce emissions at a faster and faster pace, the price of carbon allowances will go up and there will be more used to offset carbon allowances, which inevitably will be a little bit too high. So for us, it's a benefit for portfolios in terms of the increase in carbon prices, but also it can act as a portfolio level CO2 emissions offset.
Yeah, and I guess some of those ESG trends are long term. I mean, the potential of those trends won't be realized over a year or 6 months or anything like that. Some of these are multi-decade trends even. And it makes me think whether there are any governing principles in terms of RBC's investment time horizon. Obviously, this will differ from team to team, fund to fund, but are you a typically longer term thinking fund and company, or are there any sort of governing principles you can speak to there?
So I would say that when we look at performance of funds, we don't look at it on a month-to-month basis. Mm-hmm. We would look at it more on a minimum a year, an outlook of a year. Having said that, we do engage in some tactical moves where we think they are validated. So we don't just buy and hold in terms of our investments. We can take tactical positions, but in terms of the performance, long-term performance is really what speaks.
Yeah, absolutely.
We hope you're enjoying the episode. For interviews like this every Thursday, subscribe wherever you get your podcasts. And while you're there, make sure you give us a star rating and leave guest suggestions along with any other feedback in the review section. Now, back to the show.
So I want to move us on to the next section of the podcast. And it's not often that we get someone that has such a sort of global remit such as yourself. So I'd like to go on a sort of whistle stop tour, I suppose, around the globe to get your investment outlook for each key region. So let's start in the US. The Dow Jones, the S&P 500 and the NASDAQ have been extremely volatile in the last few weeks. You had the NASDAQ, for example, which fell below its 50-day stock market average, a red flag perhaps, as far as bubbles are concerned. So do you think investors are starting to lose faith in big tech?
So I don't think it's about losing faith. I think that historically, when the economy moves past the peak acceleration, which we're a point where we're close to, then equity returns tend to slow. Style, factor leadership becomes more ambiguous, and the relative performance of sectors becomes a lot more dependent on bond yields. And we expect rising bond yields. We expect for the 10-year US Treasury 10-year bond, we expect 2% at the end of this year, 3% at the end of 2022. So we expect rising bond yields. We expect a steeper yield curve, and typically those support continued outperformance of cyclicals and value. And typically they are a lot less good for longer duration growth sectors like tech. So I don't think it's about losing faith in what tech can achieve. I think it's a function of the market where when you have above average GDP growth, value cyclical stocks tend to do better.
Okay, yeah, makes sense. And I think we can briefly cover this one, but it might seem counterintuitive to some that some of these businesses, big tech businesses, 90% of the S&P 500, for example, have seen 46% year-over-year EPS growth. So from a business perspective, they're performing well, but share prices, at least since this time last month, are down, essentially, particularly for the S&P 500 companies. So is it a case of, I guess you've got the secular more trends that you've just mentioned there, but is there also a case of the superior business performance having already been priced in, and largely over the next 6 months, for example, the short term, we're going to see that trend continue downwards?
So I think that's the case, that the response to an exceptionally good earnings season was really overall muted. When earnings beat expectations, there was hardly an increase in share prices, but when companies missed, share prices corrected quite heavily. So that indeed would suggest to us that a lot of the good news had already been discounted in prices. And when you look at valuation levels, the US market on 22 times, valuation levels are high. So again, yes, a lot of good news discounted.
Yeah, okay, absolutely. That makes sense. And you called it out at the start of the podcast. How much does the fear of rising inflation play a part here, do you think?
So that's also a very big factor. Certainly, inflation fears, inflation of tapering happening a little bit earlier, and also, the resurgence of COVID. It's something that wasn't there necessarily a month ago, but in some countries, emerging markets in particular, in India, and whether that variant is coming over to other countries, that's another worry of the market.
Yeah, okay, that makes sense. And if we just focus on business performance rather than share price performance, a lot of people are talking about Biden's proposed capital gains tax, which is likely, I suppose, to play a big part, perhaps even in stymieing EPS growth into 2022. Do you have a take on that? What's your thoughts there?
So for the Biden tax proposals, for us, it's really this corporate taxes that would reduce EPS. So we don't know exactly by how much taxes will go up, whether it will be up to 28% as is proposed or just 25%. So the impact on EPS growth can be between 6% or 12%. So reducing earnings by that amount. To us, it will probably be mid-single-digit reduction in earnings for 2022. So that's the first year of implementation. But we think that the equity market can absorb that corporate tax hike without any major disruptions. Though, of course, there could be some rotation, some consolidation. And the reason why we're not overly worried about it is because taxes are being raised in the early stages of a strong recovery. So economic momentum and margin expansion should be able to offset at least partially the negative impact from higher taxes.
Yeah, interesting. So over the medium term, then you don't see this being a huge sort of significant factor in EPS performance over the next, 2, 3, 4 years even.
No, I think it will be a hit in the first year, but after that it will normalize, and the US will not be alone in raising taxes.
Yeah, okay, absolutely, that makes a lot of sense. So you mentioned GDP as well, so it'd be interesting to sort of take a top-down look, an economic look at this as well. So we've got GDP growth in the US predicted at 7% for this year, 5% then in 2022. So firstly, how do you expect that trend to continue? Do you think we'll continue to slow down in terms of GDP growth, or upward momentum might accelerate in 2023 and beyond? What's your take there?
So we're going to have a strong rebound this year, slightly less strong next year, but things will normalize. There'll be, in 18 months' time, there'll be a lot less catching up to do. So we expect to revert to average growth by 2023. So look closer to 3% growth in the US. And certainly if you look at what might happen in the UK, the Bank of England came up with expectations, strong growth this year, very strong growth this year, strong growth next year, but by 2023, 1.5% growth. So this is after a recession, you bounce back, and then eventually, the early gains in terms of economic growth fade.
Okay, yeah, absolutely. So that's the context for US markets then. So can you talk to us at all about RBC's exposure to US equities? What does all of that mean for your exposure to US markets? Are you over, underweight? What can you tell us there?
So we have a modest overweight in US equities. We like the earnings profile, the growth that we are going to get. Valuations a little bit pricey, but we still think that there's more attractive opportunities in US equities than, say, in the bond market. So we are overweight, and we would have a value bias. Again, going back to that rough rule of thumb of when you have GDP growth, which is above average, these value stocks, cyclical stocks, tend to do better than growth stocks.
Yeah, great. I was going to ask you about your investment preference within the US. So a value bias, that's good to call out. Okay, well, I think that nicely sums up your investment outlook for the US market. So let's move on to Europe and UK. I think we can focus on the continent and perhaps sort of take a sideways glance at the UK as well at the same time. I read a recent report in which fund selectors were surveyed that showed a sharp drop in appetite for European equities this quarter. After having been firmly in the green since October 2019, there was a sudden fall in demand in April earlier this year. So are you as bearish on European equities right now?
Not at all. In fact, we just upgraded European equities to overweight. I think a lot of people became a lot more cautious when Europe had to go back into lockdown. So many people read that would be, a huge hit to the economy. And of course, with the constant news flow that it was late in the vaccine rollout and the like. So in fact, if you look at things today, there is good resilience in the economy. The PMIs, both in terms of services and in terms of manufacturing, have bounced back very strongly from their lows. And of course, we had a hint of that because the mobility data through early spring, already in February, in March, was showing a good resilience of the economy. And in addition to that, you have the vaccine rollout, which has really accelerated. So if you look at one indicator we look at is the 2-week rolling doses per 100 people. And those numbers in Germany, Spain, and Italy are higher than they are in the US and the UK. So for instance, Germany, 11.6 people per 100 have been vaccinated. In the UK, it's about 9. So again, a huge acceleration in the vaccine rollout. Economic indicators are really encouraging. Earnings were strong, and certainly stronger than what the macro situation would have led one to believe. And we know that European equities tend to do well when the global economy picks up. So if we go back to our template that we talked about earlier on, fundamentals are improving. Valuations, if we look at the discount of European equities to US equities on a sector-adjusted basis, then that discount is a little bit too steep in our view. And sentiment, the figures you gave me are really backwards looking, and we think the sentiment is turning, and the money that has left the region is likely to come back. And so with rating strongly on these 3 factors, then we feel comfortable with an overweight in European equities.
Yeah, interesting. And being from the UK, I suppose I want to take a brief look at UK equities as well. Are you similarly as bullish on UK equities over the medium term or not?
So we're slightly less bullish on the UK. We have a market weight on UK equities. The main attraction of UK is how cheap equities are. Having said that, there are a couple of wrinkles in the outlook, one being still the relationship within the EU and the UK. Brexit is really affecting certain sectors badly, in particular the agricultural sector, and higher tensions between the EU and the UK will make helping these sectors a lot more difficult, and it could lead the EU also to take a very tough stance in terms of giving the UK equivalence, i.e. the ability of the UK to sell its financial services to the EU. So that's one thing which is a worry. Scottish independence, perhaps on the back burner for now, but that will come back to the fore. It will be a story for next year. And finally, the fact that the Chancellor wants to already rebalance the books could be a concern. So already personal allowances are frozen, but higher corporate taxes coming in 2023, that will be, another difficulty for the business sector. So there's some wrinkles. They're not in the short term, other than the EU relationship with the EU. But while we think there's still opportunities in the UK, we think they are better opportunities elsewhere.
Yeah. Okay. Yeah. Interesting. I think Morgan Stanley, at least at a country level, were relatively bullish on the UK, perhaps more so than yourself, but for the same reason. You called out the relatively low valuations or extremely low valuations, and that's their reason for being bullish as well. So that's interesting to know. And then I guess to finish this section on European and UK equities, can you talk to us about RBC's current exposure to European equities? Are you over or underweight?
So we are, as I mentioned, overweight in terms of the geographies which will benefit the most from the reopening. Italy, Spain, these are countries which are very geared towards tourism, towards services. So they'll benefit from the reopening. And also they are the main beneficiaries at the moment of the EU Recovery Fund, which is a very important landmark for Europe. But in terms of our positioning, we continue to favor consumer discretionary, industrial and materials. These are sectors which we believe are well positioned to benefit from an improving global economy, but also from long-term secular trends. Remember that Europe is really a global leader in industries which are geared towards the green economy. So a leader in industries ranging from renewable operators to green transportation, to electrification, to industrial automation. So it's a very rich hunting ground if you're a stock picker. We also like European financial sector, so they remain very attractively valued, and we see some positive consensus earnings revisions. So a lot to choose from in Europe.
Yeah, absolutely. And you mentioned the EU Recovery Fund there. I mean, the sort of public response, I suppose, has been relatively flat. I just wondered whether you had any thoughts on kind of whether the sentiment around that fund is likely to change over the short to medium term, or are you already seeing it change perhaps?
So look, as I mentioned, it's a very, very important landmark in the development of the EU. So between that and the expansion of the ECB balance sheet, it really means that the pace of mutualization of European debt, the pace of sharing European debt among all members, that is really advancing. And this has been a key problem for investors who are looking to invest in the Eurozone. They were very worried that without a common fiscal policy or without a banking union, then the single currency policy really required a sharing of the debt. And that is what is happening. So, I mean, these are very, difficult issues. You said there's been a flat public response. I'm not sure which public you refer to, but certainly it's a very important achievement. And as you know, European equities have done really quite well since the recovery fund has been put in place, and that is one of the reasons.
Yeah, they absolutely have. I think I read that they were the best performing region across global equities in dollar terms since it was announced in last May. And I guess in terms of the public response, it's probably a biased sort of UK media point that I'm making there. Obviously, the UK media have their own motivations for making that seem a relatively flat announcement. So, very interesting on European equities. And let's finish. I mean, you talked about your sort of value growth bias in relation to US stocks. What's your bias here?
So our bias of value over growth does not change by region. For us, it's a global phenomenon.
Yeah. Okay, that makes sense. Well, let's finish then, before we move on to our quick fire question round, by focusing on emerging markets. Brazil, India, and Mexico are among 5 countries hardest hit by the pandemic, so far. So there isn't much sign of the limited vaccine rollout being rolled out in those countries, or the wider battle against the pandemic even affecting emerging market equity markets at the moment, at least. The MSCI EM stocks index is up around 47% over the past year, for example, similar to both global and US stock indices. Why do you think that is?
Well, I think it's because of the makeup of the MSCI emerging market index. When you look at the index, remember that China is almost 40% of the China, one country. Yeah, that is what moves your index. India is about 10% of the index. Brazil, less than 5%. Mexico is even smaller. So much as it pains me as a former Latin American analyst, Brazil and Mexico just do not move that index. What moves the index is China. And if you think of China, they responded to the pandemic very quickly. They were able to reopen and to have a bounce in their economy a lot earlier than we did. It was under control. So it's really the Chinese situation which has driven the emerging market index.
Yeah, absolutely. And I read that investors have gradually moved around $14.2 billion just in April back into emerging markets, having pulled out around $83 billion from EM equity and bond markets at March 2020's peak. So you talk about China there, that makes a lot of sense, the positive story there, and that might be one reason for moving capital back into these markets. Are there any other reasons you'd like to highlight that are inciting this positive sentiment we're seeing for EM markets at the moment?
Yeah, so the flows into emerging markets, they really started to grow last year in Q4. That's when they really started to increase in a quite a substantial way. And one destination is bonds flows into China, and that's because Chinese government bonds are going to be included in the FTSE World Government Bond Index at the end of this year in October, and that reflects China's progress with market reforms and increased access to global investors. But for investors on only a very, very small allocation of Chinese government bonds, the estimates I've seen is like 3% against a benchmark weighting that could potentially rise to as high as 15%. So it's reasonable to expect that there is stronger than normal institutional buying of Chinese government debt in the months leading to the index inclusion.
Yes, okay, that makes a lot of sense. And I kind of read and picked up, I suppose, on a desensitization to what's going on, kind of the epicenter of this pandemic, which is, as I say, in Brazil, India, and Mexico. It felt like markets were a little bit desensitized to that because of the promise of the vaccine rollout and kind of how well other countries are doing at kind of overcoming this global pandemic. And I guess the expectation is that these EM countries will follow suit. But does that belie some of the infrastructural sort of difficulties that some of these countries will have in achieving such significant rollout, for example? Like, have you got any thoughts on how that might develop and how maybe that isn't being properly priced in, perhaps?
So again, if you look at index level, it's about China, and sadly, the terrible situation in India, in Brazil, in Argentina. They're not driving financial markets. Things are going to be very difficult for these countries for many months to come. So for us, our exposure in emerging markets is really mostly in China. We're still positive. We have an overweight position in China. We're perhaps a little bit less enthusiastic than before because, the country, growth is starting to slow a bit. The debt burden is very high and is making headlines. And then you have all these investigations into technology company CEOs. So it all makes for a slightly more complex investment picture. And then you add the fact that valuations are not as cheap as they've been. So while we're still positive, a little bit less so.
Yeah, okay. And to finish this emerging market section, then, how about on a sector level? Where are you most bullish within emerging markets at the moment?
Look, sectors such as in China, the big opportunity for us, particularly in China, is what we call SUSTech. So sustainability through technology, and I've mentioned those before. And China has some very interesting secular growth trends, many of which are only now coming to the Western world. And so that's where we would see our opportunities.
Yeah, interesting. That's not actually a term I'd heard before. Are there because we're speaking largely to a retail market on this podcast. I just wondered whether there are any funds or ETFs that give specific exposure, to that trend. I don't know whether you've got any thoughts on that.
So there are some indices, some MSCI indices, which replicate sort of alternative energy industries. But may I suggest that you get in touch with RBC Wealth Management, and we can take you through all of these ideas.
Yeah, absolutely. Okay, great. Nice little bit of advice for the listeners there. So let's finish by focusing on our quickfire question round. So this is a more sort of generic list of questions we ask to all guests, whether they're fund managers, personal or private traders, or even authors of famous financial books even. So they should relate to everyone that we speak to. And I guess it's just a lighthearted way to end the episode. So feel free to answer in as little as one sentence or even one word, if you like. The first question, in your opinion, what is the top mistake investors make?
So the top mistake that I have seen investors make is that they hold on to bad investments for too long.
Yes, absolutely. That's one we've heard on here before. So yeah, really solid advice. Question 2 then, where do you go for investment or economic insights? Do you read specific publishers, for example?
So look, I think it's very important to read a very broad array of publications. It's important to hear diverse views, even if you don't agree. But the one thing I like to do, I like to go on Twitter, and there are a lot of very good analysts there. Who may not, be with a big brokerage house, and you might not hear about them, but they have, they make very good analysis and share their thoughts. Many are retired or semi-retired, lots of experience, economists, university professors, strategists, full of wisdom, and without a product to push. So I think there's a very good source of information there and thought leadership there.
Yeah, interesting. Yeah, I guess they're able to sort of remain objective, given they know that they don't have the allegiance to a particular product or company. Are there any that stick in your mind that we could point listeners to, perhaps?
Well, I wouldn't want to give names, but you find one, and a good one will himself or herself follow other good people, and so you end up having a good thread of again good thought leadership.
Yeah. Okay, great. So question 3 then, what is the most memorable moment from your career to date, do you think?
So that's a difficult one. And I think the bias is that one thinks automatically of what happened in the last 10 years. But if I go back to my experience in Latin America in the early 1990s, I mean, those were really extraordinary moments. You would hop on a regional flight, a 10-seater, and you would go to Chihuahua to meet the management of a ceramic tiles company, and you would go to Medellin and meet management of a regional retail chain, and be in the country that had inspired Gabriel Garcia Marquez. I mean, it's just for somebody in their mid-20s, that was just absolutely extraordinary. If I think more mainstream in terms of the last 10 years, I've had very, very good career progression at RBC, for which I'm very grateful. And being made a managing director, I mean that was a big achievement there are very few women in the financial industry who make it to that stage. And I feel, very honored to be able to be there.
Yeah, absolutely. I was thinking about asking sort of about female representation within the financial industry. I wonder whether it's a good point to quickly pick it up here. Because it goes without saying almost that they are underrepresented, particularly at the top level of big financial institutions. Do you see that changing at all? Are you, I guess, optimistic about the future in that respect?
Look, I see a lot more efforts being made. And unfortunately, it takes a very long time for the progression to be seen. But certainly, I see a lot more effort being made in terms of not only hiring young women, but also trying to retain them in the job market, particularly after they have had children. That's when really the majority drop out. It's a very grueling schedule to have both, a young family and a full-time job. And I see a lot of efforts being made. So I am hopeful. I'm also frustrated because it's taking a very long time.
Yeah, no, absolutely. And there's probably a whole other podcast episode in that, but I completely take your point. I can imagine it's extremely frustrating. So thank you for that. Sorry, I deviated from our quickfire question round there. So question 4, our penultimate question. A top tip for your younger self. If you could go back in time and give yourself a tip, what would it be?
Assuming I would have listened to my younger self, or my older self, rather to my older self. Look, I would say enjoy the trip and don't worry too much about the exact final destination.
Yeah, okay, absolutely. So our last question, I suppose this is the Opto question. We aim to speak to the investors that are outperforming typical benchmark and returns, I suppose. And we like to ask them where they think people are best served to derive alpha. So in your opinion, what is an investor's best source of alpha if you had to narrow it down to one thing?
I think you have to be consistent.
Yeah.
A lot of consistency, a lot of logic, and apply that reasoning all the time.
Yeah, no, absolutely. I think we had someone on the podcast a while back, actually. He was just a private investor, but he talked about almost becoming an algo yourself to make your process almost machine-like. So the thinking is done before you're in the trade or before you're in the investment, to take, I suppose, some of the subjectivity and the emotion out of actually trading on a day-to-day basis. So I think that speaks to that point. I think that's a really interesting insight to finish on. So thank you very much, Frédérique, for giving up your time. It's been a real pleasure.
Thank you very much for having me.
Thanks for listening, everyone. Just a quick note before we sign off. If you're looking for an easily digestible daily update on the markets, this might be of interest. Opto Updates is our short newsletter sent every day during the trading week, giving you a bulleted list of the top 7 stories from the global stock markets. We've done the hard work for you, highlighting relevant opportunities and trends. And in addition, we'll also keep you notified of any new products, stock reports, or webinars from the Opto world. If you're interested, sign up using the link in the show notes. And thanks also to Co-Fruition for consulting on and producing the show. Until next time.